All right, folks, don't look now. Technology, 55% of cap spending. Some people will say that's nuts, but look at that chart very carefully, right? Because what strikes me most is this has been a steady climb since 1960. This is not necessarily news. Now, the good news, of course, as my next guest will point out, is that business investing in general drives productivity, and that generally drives profits. I'm going to bring in now Kevin Caron, Washington Crossing Advisors, their co-CIO, also senior portfolio manager. So, when folks are saying this is a red flag, you don't necessarily see it that way.
No, I think you can have two things. You have a cycle. Capital spending is a cycle, which means ups and downs. But then you have, as your chart just pointed out, a long-term trend, which probably continues. So we're very bullish on AI for the future, but we're mindful that history has taught us lessons that capital cycles are, well, cyclical. And so we need to prepare for both sides of this.
But we're now bracing for $7 trillion in AI spending associated with data centers. I mean, do we need to even be concerned about this? Should we just say 7 trillion we're an autopilot? Should we even fight that?
Well, that's the marketing number, Charles. So that was thrown out there for the next few years, and it's creating a lot of interest in the group. But it doesn't mean $7 trillion today, and there's some uncertainty about that in terms of time horizon and magnitude, et cetera. So it's a nice number, right, but we'd live 1 year at a time.
It is interesting, though, that 3 years ago, they weren't investing enough for Wall Street. Then last year, they were investing too much. There would be no return on investment. This year, earnings season, everyone bumped their numbers up, and they were rewarded for it. And I bring that up because you talk about mega cap and mega tech names, and I have also all show long, just how much they've been a large portion of the return. And should investors, maybe they're too comfortable thinking that's going to be in perpetuity.
Absolutely. So if you look just for, let's say, from the end of March, the rally up through today, 90% of the return has come from companies that are all tech related. So it's all the same theme. And all of that 90% came from companies whose betas or risk is 1.5 or higher. So this is a market that has for 3 years now been in love with risk, been in love with the AI theme, but all of those stocks, they all have the same thing in common. So it's maybe 10 stocks, let's say, that are driving the market, but it's one theme that's been driving the market. That's not a diversified portfolio.
Last time you were on the show, you reiterated Google, which you've had more than one time on this show. You also said you like Microsoft. So last week, Ackman makes big news. He's betting on Microsoft. And not only is he betting on Microsoft, he sold almost all of his Google. Ironically, so did Bill Gates. He no longer owns Google, which is kind of fascinating. But some other folks have made the opposite trade. So which one, are you leaning toward one more than the other?
No, we own both of them at Washington Crossing. And all that's happened is that Microsoft trades at now a discount to where its historic multiple has been. I think it's gone from about 23 times or so enterprise value to cash flow to about 18, and Google has done the opposite. So if you think of them as two companies together, they both trade on average at about 23 times cash flow, which is not too far off from the market, and I would own, and we own both of them as essentially as a set.
Let's talk about some stock ideas, because you're putting your money where your mouth is. Broadridge Financial. This is one of the ugliest charts I've seen in a long time. But ugly also potentially means opportunity. I mean, it was $250 this year, now it's down to $150. What happened and what's turning it around?
So what's happened is the market has had to very quickly and without a lot of information decide between AI winners and AI losers. And so the market has discounted these stocks and brought the expected growth rates down to low single digit. So these stocks that we're going to talk about, they can all easily beat the market expectations for growth that's laid in front of them, while the other side of the trade, the AI darlings, those have all traded to very high expectations. So going forward, especially if this turns out to be a cyclical cycle, those companies may struggle more, believe it or not, than these companies that have been beat up a lot.
Well, yeah, higher bars, certainly higher hurdles versus no hurdles maybe, because Accenture, same sort of thing, household name, a dominant name in its industry, but also getting absolutely hammered because the notion is that AI will make them irrelevant.
Yeah, and you can't have two realities. So if you go ask the 30 or so analysts that are covering this stock and the other stocks as well, what you're going to see is not a bunch of analysts who are cutting their numbers because business is so bad. Every single one of these stocks have higher earnings expectations from a year ago, higher earnings expectations next year, the year after, and the year after. So one of these two things have to dominate. Either these quality companies exist and they continue to find a way to grow, or the companies are in real trouble, but no one has told the analysts yet. So we'll see.
And the analysts who truly do follow. You also like ADP, same sort of scenario. I want to get less than a minute to go, something that you wrote that I thought was important about risk management strategies are about cushioning the inevitable drawdown that will likely occur when the theme runs its course. Cautionary stuff, obviously, but again, it's hard when people may have heard this 6 months ago, a year and a half ago. Are there going to be some yellow flags at least that will make this that could help penetrate this message a little better?
When companies put up good numbers and the stocks get punished, it means that expectations are too high. Knowing that capital spending is a cycle and it has ups and downs, and knowing the nature of stocks in general, that they don't only go up, they also go down. Good risk management means not avoiding risk entirely, but making sure that you're compensated for the risks that you're taking, and that's what we're trying to do at Washington Crossing. Right,
and I think that's a skill set that most investors don't learn, or they learn the hard way. So glad we talked about it.
Great to see you.
Good stuff, Kevin. Appreciate it. All right, folks, coming up, all eyes on NVIDIA.